So welcome back to another webinar organized by Princeton for everyone. And today I jump into action and I will talk about inflation, safe assets, and fiscal debt sustainability. And it's based on joint work, based on two papers I've written with Sebastian Merkel and Yuli Sannikov. And welcome everybody for this webinar. So if you look back, what are the different theories of inflation or monetary theories? Roughly, you can categorize them in different groups. Of course, the most predominant one is the New Keynesian theory, which is based on price rigidities and wage rigidities. And you know, the famous Phillips curve essentially gives you some indication. And we had a webinar earlier with Amy Nakamura. She went in detail about this Phillips curve and the price rigidities and wage rigidities, the way it holds. If you go back in history, of course, before the old, very old quantity equation, the quantity theory is very prominent and was actually revived under monetarism and got very, very much emphasis in the 70s and the early 80s, and very much focusing on the quantity of money, M here. More recently became more prominent the fiscal theory of the price level, or generally fiscal theory of inflation, which emphasizes not the medium of exchange role of money, but the store of value role of money, or the safe asset role. And the key equation for the fiscal theory of the price level is that the value of government bonds together with the money divided by the price level, so the real value of all the government debt outstanding and the money outstanding, is equal to the discounted present value of the primary surpluses plus some other term. And we will talk about this other term a lot today to understand that. But what's important is that typically the early papers, they're just discounted at the risk-free rate. We will argue that this actually, the stochastic discount factor, is a very delicate and important element of the fiscal theory of the price level. It's time varying. And you know, all the frictions and many, many elements are going essentially into this discount factor. And it also moves over time, and whether you go in a recession or not in a recession. And that's where the safe asset aspects come into place as well. Now, let me talk a little bit about the bond, the debt outstanding, government debt outstanding, and the money. What's the relationship between the two? In particular, if you live in a low interest rate environment, and in particular, if reserves also pay interest. So in the olden days, reserves didn't pay interest, but now they also pay, like bonds, they also pay some interest. So what's the difference between reserves and the government debt? So what's so special about reserves? In a sense, when they pay interest. And you know, as you know, the advantage of cash will also go away, and we move in a world that's very much dominated by fintech and other things. So the cash aspect becomes less and less important, and the amount of outside money is mostly given by reserves. So what's a special role of reserves? Was it a special form of government debt? And essentially what I mentioned this before in this webinar series, it has infinite maturity. So it's like an equity. You never have to pay it back. There's no rollover risk. And you never have to pay it back, but it has zero duration. So typically for bond pricing, maturity and duration are closely aligned to each other, but for reserve, it's exactly at the two extremes of the spectrum. So it's a zero duration asset, has the same duration as overnight debt. Okay. And the third element of reserves is that it can only be held by the banks, and it must be held by the banks. So the banks can't get rid of it. They can't offload it. And you know, if you lower the interest rate on reserves or even go negative, you essentially impose a tax on the banking system, and there's no way for the banks to get around it. So in particular, if there's a high inflation environment, you can have imposing a negative interest rate or very low interest rate on reserves. The banks cannot get rid of it. And what QE then is, when the government buys, let's say, government bonds, swaps it for reserves, it's just swapping one form of debt for another debt. So what I will do today, I will actually combine it and put reserves and government bonds, everything together, and I will not make the distinction between money and government debt. And this way, you know, we have a more broader perspective on it. And I ignore the fine distinctions. I will mention it when there is a distinction between the two, in particular with respect to cash, but this will not be the emphasis of today's talk. So in general, when people think about inflation, they think about, you know, wage pressures and all these things, but a big component is also they're worried about the fiscal situation, about the debt level of the government. And if you look at the United States, you have essentially government debt levels that's in the Second World War, it went above 100%, and then it came down after the Second World War, and then it came up again. So we have the Great Recession, a huge jump. We had before the pandemic already an increase because of the corporate tax cut by Trump. And then we had the pandemic with a huge jump again. And then the projection of the CBO, the Congressional Budget Office in the United States, is that, you know, the debt level is going beyond 200% of debt to GDP ratio. So we have an increase in the debt level in the United States, you know, which is unprecedented. And the question is, will this have some implications on inflation? Will have this implications what people who value this debt? Why are is this debt so valuable? And of course, it always helps if we do monetary theory to look at Japan, because Japan experimented with many of these phenomena. And if you look at the primary surpluses, how big is the deficit or the surplus per year for a country? If you look at Japan in the last 60 years, so from 1960s onwards, there were always primary deficits. There were a few years, 8 years with some primary surpluses, but otherwise there were always deficits. And the question is, if you essentially have always deficits, so the bondholders never get anything back, there will be always a deficit, or how can it be that the bonds are so valuable, in particular, you know, also in Japan, also in the US and so forth? And wouldn't this lead naturally to inflation in order to devalue these bonds? And why is this not the case? And that's one of the questions we would like to analyze today. So how do you value the government bonds? And so to think of a repressive agent, for example, there's one agent who buys these government bonds. And what does he get as cash flows? If he holds all the bonds in the economy, he gets his primary surpluses. So whatever the economy, the government pays in terms of primary surpluses, it means it pays back more than it issues new bonds. The present value of that, that's the real value of the government bonds. So the nominal value of government bonds with the script B divided by the price level, that's the real value of the government bonds. I threw out the money because, you know, reserves are not, they're also a form of debt, they just have a different maturity. And I don't look at the rollover risk aspects right now. I will come back to this later. And that's a famous fiscality of the price level equation. And I would argue there's something missing here. And I would also argue we have to think more carefully what discount rate are we taking here to get the present value. Okay, and that's what will be the focus. And there is, of course, a link here to inflation. You can see if there's something going on, if there's a primary surpluses, expectations about the future primary surpluses are changing, then there should be a change in the value of the government debt. That means change in the price value, the denominator here, that leads to inflation or low inflation, high inflation, whatever. But the question is, can you actually run primary surpluses forever, meaning that this number is actually negative all the time? And if you just plug it in, if you discount negative numbers further and further, you would just get a negative number here on the left-hand side. So the value of government bonds would be actually negative, which we don't see. So that's an indication there's some term missing here, which we would like to understand today. Okay. Now, what we argue, the term missing is a bubble term. Okay, and then that allows countries to actually have primary deficits all the time to a certain level. The question is, how big can this be? Is this significant or not? Okay. Now, can we run primary surpluses forever? It seems like the Japanese example shows you can do it. The projection for the US seems like there will be a primary deficit forever, so the negative primary surpluses forever. And without creating inflation or devaluing the bond or even creating this negative term. And that's the case, you can do that if the interest rate on the government bond is smaller than the growth rate of the economy. And typically the way one sees it, if you have some debt to GDP ratio, if the debt has to be rolled over and you have to pay the interest, it grows at the interest rate R, but the GDP grows at the interest rate of at the rate of G, then the ratio actually comes down over time. But the way I would like to look at it today is that what's the real value of the government debt? The real value is the expected present value of primary surpluses. And let's suppose the primary surpluses, they're negative, so they're deficits, grow at the size of the economy G, and then we discount it at the rate of R. And if R is smaller than G, this whole thing explodes. So this explodes at the rate of G, but we only discount at the rate of R when we bring it to the present value. So this whole thing goes to minus infinity. So all these primary deficits, negative surpluses, that grow at the rate of G, we discount it at a smaller rate than the growth rate, but then it becomes minus infinity. Now, given that we see that the bubble value is positive, so the bond value is positive, it has to be that this bubble term is going to plus infinity. And indeed, when you write down a model, you can generate that actually this will be minus infinity and this will be plus infinity. And then you get this positive value and this, because this bubble term is actually going to plus infinity. But then this equation becomes less useful because you have this minus infinity, plus infinity, and this leads to some, positive number. And it's very hard to handle this minus infinity and plus infinity. So the FTPL equation is not so useful anymore. Of course, what pins down in equilibrium is another equation, this real value of the bonds. What pins it down is essentially the goods market clearing condition. And the intuition is the following: if people hold the government bonds, and if the value of the government bonds becomes higher and higher, they feel wealthier and wealthier, and then they want to consume more. And if there's not enough goods out there, it will not work out. Okay, and that determines essentially what the value of the government bonds are. And so this way you can pin down this from the goods market clearing condition, but you have to use other equilibrium conditions to pin this down rather than the FTPL equation. So the question is, can we actually fix this FTPL equation in such a way that it becomes useful again, even in the case when R is smaller than G? Okay, so that's the exercise. And you could say, yeah, we can discount at any rate larger than G. Let's call it R bar. And we just use R bar. So the surpluses grow, or the deficits grow at the rate of G. We discount at a larger rate of G. And then this whole thing becomes a finite thing. Okay, so that's essentially one way to do it. And if you do the same thing for the second term, this also becomes a finite term as well. So we have something which is negative, but not minus infinity, and something which is positive, but not plus infinity. Okay, just having a higher discount rate rather than larger than G, which is not equal to the market rate here. So in a sense, we would like to find an R bar, I correlate R bar, which is meaningful, which makes these two terms meaningful, and also is meaningful on its own. Okay, so you can actually discount any rate here. So for example, Ricardo Reis uses the marginal return on capital. That's also possible. But I would argue actually there's a particular R bar which has a meaning to it and is meaningful to do. Okay. Okay, so what is this R bar? And I would argue later on, the R bar one should use is a representative agent risk-free rate, okay, which is not the same as the return on capital. Now, to understand this R, to understand the risk-free rates and all the rates, we go back to an equation we have covered earlier. So what's the risk-free rate? So the risk-free rate and other rates more generally, the risky rates on top of it, there's a risk premium on top of it, consists of some time reference rate, how much you value future utility compared to today's utility. It plus the expected growth rate of consumption. So if you're very wealthy in the future, then actually there will be a higher rate because, in the future you will be wealthy, your marginal utility will be much lower. So you would like to bring consumption to today, but we don't have it today. So we have to reward somebody who wants to consume and delay consumption. So that's why the interest rate will be higher. And then there's this precautionary savings terms. And the precautionary saving comes if there's more uncertainty. The more uncertain there is, the more you want to save. And because of this saving, it depresses the risk-free rate. And it could be aggregate risk, so the variance of the consumption growth rate. And from an aggregate perspective, that's what I call this aggregate risk here. And it could be idiosyncratic risk. Okay, whenever I put a little tilde on top of the thing, then it's idiosyncratic risk. Okay, these are the two different risks we are facing. And that's the risk-free rate, the true risk-free rate before we put anything on top of it. Of course, if you look at government bonds, there might be some risk involved, some inflation risk. There might be that the safe asset status will go away. So there's probably a risk premium on top of it as well. But we will talk about this later, but not now. And then there's something which is often referred to as convenience yield, because I can use government bonds as collateral. So that's one way I can use them as collateral. That gives me an additional convenience yield that actually, because I get this convenience yield, the return I get on the bonds is lower because anyway I get some convenience yield. It relaxes some collateral constraint with certain Lagrange multiplier. And then if I want, so that's my R, that's the return on the government bond. So that's what I've denoted here as a government bond here, all these terms together. And if you say what's the return on money, on physical cash, if we don't pay interest on cash, there's an additional return, this delta I on it. Oops. So we have this delta I on top of this thing here. Okay. I will not focus so much on the delta I, but let me first say a few words on this collateral constraint or this convenience yields and what these other elements are. And the argument often is that, oh, this convenience yield is rather small. It's an icing on the cake, as John Cochrane calls it. And, here I just plotted from Fred, you have the 30-year treasury, you have 30-year mortgages, and you have some corporate bonds, high-quality bonds, and you see they all co-move nicely with each other, and except for crisis times, and it is some basis points, but it's not dramatically big. So it's not really driving the whole thing. So there's some questions here where this equation is coming from. This equation is very general. It simply comes from looking some expected utility maximizer over time in a continuous time framework in order to keep it tractable. And what I assumed here is log utility. So the risk aversion coefficient is 1, so gamma is 1, or the intertemporal elasticity of substitution is 1. Otherwise, it would show up here, and there will be some gamma terms here, making the analysis more complicated, but I didn't want to throw it. But you also see if the growth rate of the economy goes up, if this goes up, the risk-free rate is also going up. And if it's log utility, it goes hand in hand, 1 for 1. Okay, so now I want to do a trick, and I want to emphasize things. The more risk there is in the economy, the more people want to save in a safe asset for precautionary reasons. So they want to hold the safe asset to have some safety buffer. It's like a self-insurance motive. And that's because they might face for aggregate risk reasons or idiosyncratic risk reasons. Now, if I have a repressive agent, the repressive agent only has this aggregate risk. It doesn't have this idiosyncratic risk. Okay, so what I want to do is I want to take out this idiosyncratic risk because a repressive agent wouldn't have that. And a government is one big government for all of the citizens. So I want to take this one out. And essentially all what I do is I move this term, I move it into the convenience yield term. Okay, and what I call then I have one term less here. And this is my risk-free rate for this repressive agent now, this hypothetical repressive agent. But now I have this idiosyncratic risk term over here. And instead of calling this whole thing convenience yield, I call it service flow. Service flow consists of some idiosyncratic risk term. And I want to explain this later, this idiosyncratic risk term, and the convenience yields we have normally. Okay, that's the standard convenience yields people have measured. Now, what is this risk-free rate here with a bar there in red? That's the repressive agent's risk-free term, which does not include this idiosyncratic risk in here. Okay, so it's not nothing dramatic. I just move that. And once I do that, and once I discount, that's essentially the discount rate, the R bar. That's the discount rate I would like to move, I would like to use in order to get away from this plus infinity, plus minus, so minus infinity plus infinity representation. Now I have two finite terms and I can interpret them. And the second term will be the service flow term. And that's what I would like to interpret. And I would argue it's a meaningful term. The first term is meaningful because it's some repressive agent economy thing that's meaningful in this sense, even though in the economy, everybody's heterogeneous and all that. It's a construct. And the second term is some service flow. Okay, and to illustrate that, I would like to argue that, so we have the value, real value of the government bonds again, or for any asset, you have the expected present value under discounted now with this R bar of the primary surpluses plus some service flow. And for this example, I make a very simple example. Let me just switch off the primary surpluses, make them all 0. So this first term goes away. Okay. Now let me just consider two people, A and B, Alice and Bob. And let me tell you that, they have a portfolio each. They have a cash flow asset, that's a physical capital which produces apples. And they have in their portfolio also some white piece of paper, okay, called government bond. It never pays anything. It has just 0 cash flow coming in. And that's the one I would like to value. So the first term, 0 cash flow ever coming in, that the first term is going away, but it should have a service flow. And the additional assumption is this idiosyncratic risk. Alice and Bob face idiosyncratic risk. They face different risks. If washing machine breaks down, car breaks down, or whatever the thing breaks down. And that's still going on. And they might be able to self-insure each other by retrading this non-useless asset. Inherently, it has no cash flow, seems like useless, but these white pieces of paper are somehow useful for insuring each other. So they can't write contracts directly to each other, but they can self-insure by holding these white pieces of paper. So what's going on is that if the world moves in this direction, then it will be the case that Alice has a positive shock on her capital, but Bob has a negative shock on his asset. Okay. While if the world moves down, Alice will have a negative shock and Bob has a positive shock. So ideally, Alice and Bob could nicely insure each other, but there are some financial frictions that can't do that. Okay, there might be moral hazard issues to incentivize Alice and Bob to work hard and other things, but it doesn't really work so well. So what they can do is they can both hold these white pieces of paper, which never pays any cash flow. And if this world realizes, then it will be the case that Alice will buy some more white piece of paper from Bob at a certain price and swaps it for this cash flow asset. Okay, so they swap this. And if the world moves down, then actually what will happen is that Bob will buy some white piece of paper in return to this cash flow asset. So essentially, depending where the world moves, Alice and Bob will swap these white pieces of paper. Okay. So even though they cannot write direct contracts and they cannot insure each other, they can actually, through this retrading of this white piece of paper with this other physical capital, let's say on this other asset, they can actually partially insure each other. Okay. So that's essentially holding from an ex ante perspective for precautionary reasons some asset which pays no dividends and no cash flows. It is useful because it allows some partial insurance later on. Okay, and that's what we call the service flow, and that reduces essentially the volatility or the variance of the growth rate of consumption. Okay, for these guys, for these individual guys. For the planner, it's not an issue because the planner cares only about aggregate things, but there's a lot of idiosyncratic risk. Your car breaks down, mine doesn't, and so forth, which shows, and then the world goes on. And this asset, this white asset, even though it doesn't pay any primary surplus and should be actually worth less, then it has still value because the service flow is there. It can allow us to self-insure each other. And that's what the illustration is. And that's why this second term is very important, and it shouldn't be ignored like in many standard asset pricing settings. Okay, so that's essentially what's very crucial, and that's also what we call a safe asset. A safe asset is an asset which is around, you can use and sell to replace, to go after this shock you faced at that time. So a safe asset has these two components more generally. It has expected present value of cash flows, which might be negative, but because of the service flow, it also has the service flow. And it's like a good friend. Whenever you have a shock, whenever you're down, it has some value, you can sell it. And the fact that you can sell it for a positive price, even though it never yields any cash flows, is like a good friend. It's around for you. And that's what and the other thing is, it's a safe asset is valid in equilibrium, but there's always another equilibrium where it is not valid. So in a sense, the safe asset is a bubble, because if you just price it based on the cash flows, which are always zero, it should have a zero price. But there's a bubble equilibrium where this other component, the service flow, comes in, and then the asset price has a positive value. Okay. Now, that's essentially what's going on. And what you have essentially, you have the safe asset there, and the government is issuing, for example, government bonds. The government bonds pay some interest, pay some primary surpluses, mostly negative. So it could be this is highly negative. And then because this is more than offsetting that, nevertheless, the total value of the government bonds is positive. And the real value, that's the real value of the government bond. And that determines then also essentially the nominal value divided by the price level. And the change in the price level is our inflation. Now, how many new bonds the government is issuing affects, of course, this is the value of all government bonds outstanding. So all of the government bonds. But if the government is issuing new bonds, it dilutes essentially the value of the existing bonds. And of course, people anticipate the government will issue new bonds because the CBO projections say the government will have to issue more and more bonds given the primary deficits coming up. And that this dilutes the value of the bonds. Okay. So the primary surplus deficits grow at the rate of G. So the deficits, let's say, grow at the rate of G. But the government might issue some bonds at the rate of mu B. That's the growth rate of the government bonds issue, given the deficits of the things. And this dilutes the value of the bonds. And diluting the value of the bonds you're holding is like a tax of holding these bonds. And here, we hold these bonds to retrade. But that's the only way we can insure each other. But if the government dilutes the value of the bonds, it's like a tax on the insurance, on the self-insurance. Okay, and that's how you have to view that. If the government debt expands and is expected to expand a lot, we expect to be taxed, and hence we cannot self-insure each other so much. Okay, and that's the way I would like to see. What is the value of the government bond if you change how fast or how much the government issuance of the bond setting is? So and that's something like a debt Laffer curve, and that's the first part of the debt sustainability analysis. So if the government issues bonds at a faster rate, what happens, and as I just mentioned, it's like taxing the precautionary self-insurance. So we all would like to have some government bonds for precautionary self-insurance reasons. And if the government issues more bonds, essentially it dilutes the value of these bonds. It's like a tax rate. That's what this tax rate is. So if it issues faster, the tax rate is going up. And then we'd say, oh, that's actually higher revenue for the government because the tax rate, that's what the government gets. It just dilutes existing debt outstanding. That's like taxing it. But the real value of the bonds are going down too. That means the tax base is going down as well. And that's a standard Laffer curve argument, that if you increase the tax rate, your tax base is going down, and the tax revenue is the tax rate times the tax base. So if one tax rate goes up and the tax base is not moving much, then the tax revenue goes up. But it could be at some point the tax base goes down more than what the tax rate actually generates. And that's why you have this Laffer curve. Okay. And the same argument holds here too. It's just a different activity you tax. You don't tax production of some particular good, or you don't tax certain consumption. Here, you actually tax self-insurance, the fact that people like to hold government bonds to self-insure each other. And that's what you will tax. And there is also this phenomenon here. And essentially, if you look at other research in the literature, they are focused on this extreme point. I think the more interesting point is here to look at the peak here of the Laffer curve. And that's what we do. We derive the whole Laffer curve in this paper. So there is extra fiscal space because of the self-insurance role of government bonds. It's there, but it's not so large. Okay. So and that's in a sense what John Cochran says, and I'm happy to elaborate on that. But there's something important missing. And that's what I would like to move on now. But if you have an understanding now what a safe asset is, it's an asset we can retrade and partially complete markets by doing this dynamic trading arrangement, depending whether who suffers a negative idiosyncratic shock. And that gives this asset some value, even though the fundamental cash flow payoffs are negative or zero or even negative. Nevertheless, there's a value to these assets. Now, can we quantify? Can we make this? Can this be large? Yes, it can be large, but for that we need some additional element in the model. Okay, and here is the additional element. So far I haven't introduced some macro risk. Now I will actually, so here were the balance sheets. We send these white pieces of paper, then you have some capital. That was your net worth. Everybody was holding the same thing. The whole many citizens in the economy, and they were all exposed to idiosyncratic risk, which, you know, sigma tilde is my idiosyncratic risk. Now what I do next is make it more realistic and assume that in recessions, actually the idiosyncratic risk is going up. So when you go in a recession, of course, the risk you face idiosyncratically is going up. The aggregate risk might go up too, but in particular, the idiosyncratic risk is going up. And output and productivity is lower in recession. So these are the two new elements to put in the model. And then what we'll see, the main insight is that there will be flight to safety in times of recession into this bubbly government bond. As long as, you know, the bubble stays, we stay in the bubble equilibrium. So there are many questions, and I will just allude to them. Of course, the value of the government bond depends on the government's ability to taxes. That's, you know, the ability to tax shows, you know, what the primary surplus is down the road. How can the government react? Can they actually, if there's something going wrong, they can actually raise taxes. And I will come back to this. That's also a way, this additional fiscal space is actually a way to defend this government bubble or this safe asset bubble, and how much then you can mine it. Now, the new element I would like to introduce now is the following, where you say, okay, we have the same picture as before, Alice and Bob, you know, whenever, you know, one suffers a shock, then they trade this way. If the other one suffers a shock, they trade the other way, and so forth. And they have a shock of a certain size. But now if you go in a recession, the shock is way bigger. Okay, now instead of having these shocks, now the shocks become more dramatic. Okay, so the riskiness of the system moves over time, and in recessions, the risk becomes bigger. Okay, it could be that the safety buffers, things are smaller, so the risk exposure is bigger. So that's the only difference besides the output difference, but the risk aspect is the important component. And this, how much risk there is in the system, we call sigma tilde. So sigma tilde is high in recessions and low in a boom phase. So what happens then, and so here's sigma tilde on the x-axis. So you see in a recession, sigma tilde is high, and then in the boom phase, sigma tilde is low. And what we have typically is that, you know, the sigma tilde is moving around according to some distribution, some stochastic process, and that's the stationary distribution of this sigma tilde. Okay. But what I really want to show is that if you go in a recession, idiosyncratic risk becomes high. So capital is very risky to hold, and other things are risky. You might become unemployed and other things. So the price of capital is actually going down. The more the risk goes up, the more the price of capital is going down. That's the green one here, so it goes down here. But the important thing is the value of government debt in the times of recession is increasing. Okay, that's the value of government debt is increasing, which means there's deflationary pressure. So if the idiosyncratic risk goes up in recessions, the value of government debt is actually increasing. And in recession, so that's this flight to safety. Although you have this flight to safety, people rush out of physical capital, rush into government bonds, and then the value of the government debt is increasing at that time. And if you think about it, if a safe asset, we said a safe asset is good because when I face an idiosyncratic shock, I can use it to, you know, trade with Alice or Bob, and that allows me to insure myself with Alice and Bob and so forth. Here it's actually even better because if there's a recession, it's bad for Alice, Bob, and me, for all of us, it gains in value. Okay, and that's a very nice feature to have for a government bond. Okay. And that's what gives it the whole asset, the government bond, essentially a negative beta. Okay, and that's negative beta is essentially the critical element of it. Now let me just look at the two terms separately again. So we have this cash flow term and we have the service flow term. So I might be, you know, surprised, you know, have these two terms, and you know, we are focused so much on the second term. Typically in asset pricing, you have only one term. But for any asset price, you have a cash flow term and a service flow term. The blue one is the cash flow, and the red one is the service flow term. And what I've depicted again, here we have a boom of low idiosyncratic risk, and here we have high idiosyncratic risk. We have a recession and this level. And you see the cash flow behaves. So you can think of primary surpluses. If in a boom phase, the primary surpluses are positive. And if in a recession, the primary surpluses are negative. Okay, that's like a nice Keynesian way of doing things. So you get in debt in a recession, so the surpluses are negative. If in a boom phase, you pay off your debt. That's the blue thing here. And that's the value. If you only will use traditional asset pricing, you would only value that. And you say, well, that's the value of this the asset. So the cash flow term, I should say, that's actually, I should have corrected myself. This is the present value of all the cash flows. If you go in a recession, the present value of the cash flows becomes a negative. If you're in a boom phase, the present value of all future cash flows is more positive. But the present value of the service flows goes exactly the other way around. So if you're in a recession, the present value, the second term, is actually highly positive. It's always positive, but it's more positive the deeper the recession is. Okay, and the total value of all government bonds, that's this black dashed line here. Okay, so if you add the red and the blue, you get the black dashed line. You see, the service flow dominates the whole thing. It's a very, very important component in this analysis. And you can't just ignore the service flow. That's just not a feasible thing to do. But what we see here is also that I can look at the betas, the CAPM betas. You can see that the asset price goes up in recessions. That's a negative beta. That's really what you like about these economies, or about this particular asset. As a question here, whether the bubble representation is a Ponzi game. Yes, it's a Ponzi game. It's the same thing. You just roll it over all the time. Okay, it grows. You can, let's suppose you just issue some debt and you roll it over at the interest rate of R. You never pay it back. Okay, but it provides a service flow all the time. Okay. Now, the service flow, and there's a typo here, the service flow has a negative beta. So this should be negative, should be the other way around. The service flow has a negative beta. That means it increases in value in times of recessions, while the cash flow, the blue thing here, has a positive beta. So we cannot really have two betas. There's one asset as one beta, but I could actually hypothetically say, if I were to split this asset into two assets, which are not separately traded, in a cash flow asset and a service flow asset, then this would have a positive beta, the cash flow component, and the service flow will have a negative beta. So that's what you see here. There's a minus 0.3 and so forth. That's for the service flow beta, and 0.1 for the cash flow beta. And if you combine it for the total asset, that's the beta of the total asset is again the beta of the total asset. Now, if I now put it together, what is a safe asset? We said a safe asset is a good friend. It's not only a good friend individually, where your idiosyncratic shocks are captured, but it's also a good friend for the whole economy, because whenever there's an aggregate shock, it has a negative beta. And that's essentially, this good friend analogy extends not only to individuals, where they can insure each other themselves. That's an initial motivation for the safe asset. But the fact that idiosyncratic risk goes up in times of recessions, it becomes even more important in times of recessions to have this retrading going on, this safe asset around. That gives it this negative beta, and that makes this asset even more valuable, especially in times of crisis. It makes it more valuable all the time, because whenever there's a crisis, it will increase in value. And that makes it extremely nice to have, and it's very nice for somebody to be able to issue this asset. Okay, and that's the safe asset aspect. So how can we extend now the debt Laffer curve in a world where there is this particular recessions, and in times of recession, idiosyncratic risk is going up? So you have the same analysis as before. If you issue more at a faster rate these bonds, so the deficits are higher. So what's going on is that you actually tax precautionary self-insurance. The tax rate goes up, and you might debase essentially the tax base, but it's not so dramatic now, because in times of recessions, you have this flight to safety. So when you put higher deficits in times of recessions, but in times of recessions, it's also the case that the bonds, the real value of the bonds is not going down so much, it's actually going up. Okay, so this trade-off we had before in this debt Laffer curve is much less dramatic with an economy where there's also recessions in it, and this idiosyncratic risk is increasing in times of recessions. Okay, and that's because of the flight to safety. So what we have depicted here, and that's the calibration. You can see the average expected growth rate of the issuance rate of government bonds is on the x-axis, and you see the primary deficit you can fund with that goes up to 2%. Okay, so it's not tremendous, but it's 2%. It's a significant amount of money at the peak. And then if you go beyond 2%, it goes down. So it's still very different from MMT, modern monetary theory, where you can do this. And that's, I think, very important to understand. There's a limit to it, but the limit depends very much to what extent idiosyncratic risk is moving in during recessions and versus booms. Okay, so what we have plotted here, this dashed one, that's the same Laffer curve without these recessions and the booms. You might say, but what we did is we cranked up the sigma bar so high that the two peaks will be the same. Okay, if we weren't to do this, this would be a much lower Laffer curve down here. Okay, so we really made the idiosyncratic risk very, very high in order to get the same effect in terms of the same peak as we get with this recession component in the model in it. So this recession component is very, very important. Now, let me just say one more thing. If you say now, what can a safe asset do? Can a safe asset is insuring us because we can retrade all the citizens? Can it insure the same way they can insure the bondholders? So whenever we go in a recession, the value of the safe asset goes up. So that's what we have, the idiosyncratic risk. The bubble value goes up in recession, that insures the bondholders. But can we also insure the taxpayers by saying whenever there's a recession, we cut the taxes? And if you have a standard representation analysis with complete markets, you have a Modigliani-Miller theorem holding. So you can either insure the taxpayers, so cut back on taxes in times of recessions, and that goes at the expense of the bondholders because they get less. The primary deficits will be larger, the primary surpluses will be more negative, and they get less in bad times. So their beta would be the opposite. Okay, so it would be a positive beta asset if you would do this. Or you can actually do it the other way. You say, go whenever, and many developing countries, they're forced to do that. Whenever you go in a recession, you go in huge austerity measures, and you cannot really insure the taxpayers. The taxpayers know whenever we go in a recession, taxes will go up, and so they have to suffer that. And now if you have the safe asset perspective with this income markets, you can have actually a setting where the government can insure both the bondholders and the taxpayers. How is that? Is this a miracle? No, because when you go in a recession, idiosyncratic risk goes up. The value of the bonds go up already. That insures the bondholders. But it goes up so much that you can even cut taxes. You can make the primary surpluses go down. That if you ever go in a recession, you cut taxes, you can also insure the taxpayer. So you can actually insure both. So it's because of this bubble feature coming in, and that's it's once you understand it, it's not a miracle, even though it seems to be one in the first place. Now, let me conclude with a few more thoughts on the safe asset aspect. And the many questions came on this issue already. So I will, you might lose the safe asset, okay? And so that's a big problem, where the safe asset is one equilibrium. There's another equilibrium where this white piece of papers are worthless. So government bonds are worth nothing, in particular if there is there's negative primary surpluses all the time. Okay, so this bubble can pop. Okay, and so the safe asset status might be lost. And how can you ensure that safe assets status will not be lost? Is that if you have fiscal space where you can say, okay, I can actually use the fiscal space to turn the primary deficits into primary surpluses from then onwards. Okay, so for this, you have to have some fiscal space. Do you need a lot? In theory, you don't need much of that, because you can always say, okay, whenever we get the primary, the safe asset status might be lost, I say to my citizens, don't worry, I will move to fiscal surpluses from then onwards, very small, and then this asset has positive value and I can support the bubble equilibrium. Okay, and that just an off equilibrium threat would be enough, but I have to have enough capacity that I can have this off equilibrium threat in order to sustain the bubble equilibrium. Because if this is not the case, then it might be the case that the R has all the risk-free stuff we talked about earlier, plus a risk premium, because there's a risk that the safe asset status might be lost. That is an additional, investors want additional risk premium. And if this risk premium becomes sufficiently high, then R goes above G, and the safe asset is not really the same way it was before. Of course, there's no discontinuity between R as R crosses G, but the bubble component will go away. Okay. Now, the second aspect to it is that we said the safe asset is very valuable for idiosyncratic reasons because we can just constantly retrade back and forth. Okay, so depending whether Alice and Bob suffered a negative shock, and that's important that you can retrade at a low bid-ask spread. Okay. Now, at certain points in time, like in March 2020, the 10-year Treasury suddenly, it was not so easy to trade it anymore. There was a bid-ask spread popping up. And then the Fed stepped in to become a market maker of last resort. So it's important if there's market frictions that you cannot trade your safe assets so well anymore, that the central bank steps in to reduce the low, to make the bid-ask spread low again, so you can do this retrading. So once you lose this easy retrading back and forth, you lose also the safe asset status. And then also this negative beta aspect is not coming into play anymore, because the negative beta comes also because there's more idiosyncratic risk. So we have to retrade more in order to capture this idiosyncratic risk. So this is important. The safe asset status might be lost. I don't have time to go into details. It's more delicate when it is lost, but the possibility that it might be lost alone increases the risk premium, and that makes it actually harder to sustain the safe asset status. Okay. And the other thing is that the bid-ask spread should stay low in order to have enough easy retrading. Otherwise, you might switch to another asset to do the retrading. It's not clear that it's with the government bond. Now, that leads me already to the next issue. The next issue is there might be competing safe assets out there. And actually, private bonds might be also competing, and they compete with that too. And as Jason Furman said earlier in the webinar series we had here, is that you just need to be the least ugly horse in a sense. So it's competing. If the other safe assets seem less appealing, then you can also be a little bit more aggressive in a sense. But the interest rate policy is then actually competing across countries. So if you think about different countries, and each country has its own safe asset, and you still compete then with the US Treasury as an ultimate safe asset, as a global safe asset. So as we said earlier, you think of an emerging economy. The emerging economy has the R versus G, but the R is the risk-free rate in this country plus a risk premium, and that has to be smaller than G. And you know, that whole analysis is going. We can be in this bubble equilibrium. Everything is fine. But and the second condition, if the risk-free rate has to be larger than the US Treasury rate, otherwise people might be using the US Treasury as a safe asset. Okay, so the question: do you use this national, local safe asset, or you use the US Treasury as a safe asset? And essentially, you're sandwiched between these two conditions. Okay. Now, if the risk premium goes up on that you might lose the safe asset status, then you know it might be self-fulfilling. You might not be able anymore to keep it below G. Okay. But it could also be that the US is raising the interest rate, so the US dollar interest rate is actually going up, and then you're sandwiched as well. So the only thing what you can do is actually to raise your interest rate as well in order to we still satisfy these two equations. But if you have to raise it too much, so if the US interest rate goes up too much, then actually you might not satisfy this anymore. So raising R might be on the one thing, it might not satisfy this equation anymore. And it might also depress your own growth rate. Actually, if you raise your interest rate at home, it might depress your home growth rate as well. That also violates the first equation. And so you're between a rock and a hard stone, or essentially. and you don't know what to do if the US is raising its interest rates. And that's a nice way to see the spillovers from the US monetary policy to the rest of the world in this framework, and can be quite abrupt and lead to huge capital flows across countries. In particular, for emerging economies, that's very, very prominent. So if you want to read that, you can read this International Monetary System paper, a safe asset perspective. I've written with Sebastian and Yuli as well. So let me conclude. What I tried to get across today, that what is a safe asset? We talk a lot about safe assets, but I would like to give a particular interpretation and a very clear framework how to think about it. And has two elements to it. One is this good friend analogy, and it's around when you need it, like a good friend. And it's around for individual shocks, and it's very important. You have idiosyncratic shocks, and then I can actually rely on my asset. I can sell it and replace whatever I've lost. I do some self-insurance. In this sense, it's same like an Iagari type model, but here what we have, the safe asset is also a bubble. In Iagari type models, it's not a bubble. But on top of it, there's aggregate risk. So this idiosyncratic risk becomes, in times of crisis, even more important, and that leads to flight to safety. So a good friend, not only in individually bad times, but also in recessions and aggregate bad times. What makes the safe asset fragile is that it's a bubble. There's a tautology. A safe asset is safe because it's perceived to be safe. And this safe asset definition here is different from the traditional convenience yield, where you look just at some extra elements to it. It is a service flow term, which is more significant than a simple convenience yield, which empirical research has looked so far. Okay. Now, this has implications to fiscal debt sustainability analysis. It gives you extra space, but there's still a debt Laffer curve. So it's not like MMT that you can actually just issue fiscal as you wish. It gives you some extra space, but be careful, it's fragile, and it's not tremendous. Okay. The other thing is we have to rethink the fiscal stability price level equation and the inflation implications, because not only is the stochastic discount factor moving around, we have this bubble term, and this minus infinity and plus infinity might be hard to interpret. So we have to switch to a meaningful discount rate. And I would argue it's this representative agent discount rate, as I've outlined before, because then not only is it meaningful to discount, but it's also meaningful to see the second term as a service flow term. Okay. And finally, I argued there's some competing safe assets. What really gets exciting when you have not only one safe asset, but also competing safe assets. So within a country, it's not only the government bond, which is a safe asset. There might be also, some particular corporate bonds, which are safe assets, but they might not have this aggregate aspect. They might have this individual aspect, but not the aggregate aspect. And then once you move into the national sphere, or also crypto sphere, there are different competing safe assets across countries, and there are spillovers from US monetary policy, because other countries might lose their local safe asset because US dollar treasury becomes too attractive if the US interest rate is becoming too high. So with this, I would like to thank you all for hanging out to the end, and also for the questions. I was able to address, I think, most of them in between. And I hope to see you next week again with Olivier Blachard, who probably will touch on similar issues, less on the risk focused as my presentation was here, and hope to see you next week on Wednesday, not on Thursday, so it's on a different day. Okay, thanks for following, and hope to see you soon. Bye-bye.